banking in Georgia and why we've had so many challenges over the last 3 years. And it really goes back to its roots in 2006 and before, when the economy was so good and when Georgia was growing so quickly. And what that led to was a significant amount of building, led to a significant amount of new banks, it led to a significant amount of new lending, and it looked like it was going to just continue forever. So as new banks loaned more and more money, it became more and more available to new borrowers, and eventually we got into what is commonly referred to as subprime lending. Subprime lending is as it would imply, it's not prime lending, it's below that, and it's for folks that would normally not be able to qualify for credit. And what the lenders did is they came up with a way to charge a little more in terms of rate and fee, and then extend that credit to the next level of borrower. By doing so, they ended up taking on significant additional risk. In that process, though, they were creating demand by extending that new credit, and the new demand came in the form of housing. So the more credit is available to housing buyers, the more housing is going to be purchased, and then it builds up and builds up and builds up until it's like a balloon that bursts. And so if you'll think about the housing market, or the housing and mortgage market, in terms of the players, there are two. I'm going to simplify this greatly and just say there are two major players. There's the big banks and the small banks, the community banks. So the community banks are primarily responsible for lending on land and housing, on construction, building from the ground up. And so the larger banks typically are responsible for what's called mortgage-backed obligations, or MBOs. And I'm going to take just a minute to explain an MBO, and then I'm going to go back and explain why the model fell apart. So a mortgage-backed obligation is, as it sounds, it's an obligation, it's a security, a very, very large security that's backed by mortgages. So when you or I or anyone you know initiates a mortgage, that mortgage typically gets bundled with hundreds or thousands of other mortgages into one package, and that package is called a mortgage-backed obligation. It can be any shape or size, but I'll just use a sort of a generic example and keep it simple here. The package is sold to pension funds or large investors or mutual funds typically, and what they do is they then repackage that and sell it to individual investors, just like you or me. So if you have in your investments, if you have individual investments or a 401k, you probably have an option in there called government option or secure option, safe option, and that is in many cases filled with government or mortgage-backed obligations. So picture this large chunk of mortgages in one bundle being mortgaged. And in large part, that was one of the reasons, too, why the mortgage crisis was allowed to continue. Any given mortgage that is subprime, that really is not a good mortgage, is not going to get done. But if you bundle bad mortgages with good mortgages, you create something that's not quite as bad. And so I liken it to making brownies, and right before you get ready to put it in the oven, you go out in the front yard and you get a little dirt and throw it in there with the brownies and mix it up, and nobody's really going to be able to tell at first, and they probably won't taste that much different. And that's sort of what we got with the mortgage-backed obligations. These eventually it got to the point where there was too much money flowing into the MBO market from these investors that I talked about, the mutual funds, the hedge funds, the private investors of a very large nature. And they started to see their investments were not going as well. This would have been in 2006 and early 2007. They started seeing an interesting situation develop where their investments, which were previously doing very well, returning great margin, started to fail. And the reason they were failing is because people were not paying their mortgages. In some cases of these portfolios, it got so bad that certain portfolios were showing a 30% failure rate on the very first mortgage payment. So in other words, 30% of the people that had taken out a mortgage, they bought the home, they moved into the home, or they bought it for an investment purpose, 30% of them failed to make their first month's payment. So as this situation started to deteriorate, the entities, these large investment entities, these large mutual funds and pension funds, stopped putting money into the market. And so if you'll think of it in reverse fashion, it starts with the very large mutual funds and investors, and it flows to the MBO market. The MBOs buy individual mortgages. Individual mortgages are used to facilitate the purchase of a home, a built home. Constructed homes are built on developed lots, and developed lots are developed out of raw land. And so I'm going to break down those segments. So starting at the very simplest level, at the land level, that was almost completely limited to what you would call a community bank. Community banks are generally those with less than $1 or $2 billion in assets. These are very small banks compared to the very large banks. They might have 20 or even 15 or less or fewer branches. They might be located in only one city or certainly almost completely in one state. So they're very limited in terms of what they have the opportunity to look at in terms of lending money. The mortgage, once you get a home, the next part in the process is to mortgage that home. And by mortgaging it, that means that you put a loan on it, and that is typically done by large banks for the most part, although many smaller banks do have mortgage groups in them, but most of those are done by the large banks. So then you get into the MBO that's, again, packaging those mortgages to be sold. That is done almost exclusively by Wall Street firms, the large investment firms on Wall Street. So now you know the players and you know the steps in the process. So when you start with the funding source at the very end of that process, which again is the large mutual funds, the pension funds, and other large investors, equity and hedge funds that are investing in these MBOs, they are the ones that are completely supporting the housing market. When they started seeing those severe deteriorations in their portfolios and they put a stop to it, they said they did not send a memo or an email to the market 18 months in advance or 12 months in advance and say we're going to stop. They just stopped. If they don't like something, they don't fund it. And they didn't like it because they were losing money and they could see how they were going to lose much more money. So in that process, they created a situation where there was no more money flowing into the MBO market, which means there was no more money flowing into the mortgage market, which means there was no more money flowing into the construction market, and then the development market, and then the land market. And so all along those paths, every bank that was holding those assets at any given time was stuck. And so the ones that were the most exposed and the ones that were furthest out on the risk continuum were the ones holding the land and the developed lots, which, as I mentioned previously, are almost completely focused in the community banks. So if you are a community bank and 40 or 50 or 60 or in some cases 70 or 80% of your loans are in the form of land, developed lots, and construction, when somebody in some pension fund somewhere or large mutual fund says, I'm not going to fund the mortgage market, you don't know it, but there's literally a financial tidal wave coming your way. And that's what hit us in 2007. The real tidal wave didn't hit. It was sort of like the situation with the Japanese earthquake. You had the earthquake, which was the original rumble, which happened in 2007. And then you had the tidal wave, which occurred later, which was really in late 2008 when Bear Stearns, Lehman Brothers, and others, these were 100-year-old firms, went bankrupt. The reason they went bankrupt was because they were too heavily invested in mortgage-backed obligations, which, again, were defunded by the large pension funds, mutual funds, etc. So they also got burned. As that market has continued to suffer, you have seen a downward spiral in housing prices that really has not stopped yet. And it's really only sort of leveling out right now. And this has taken 3 years. I gave a speech in Columbia, South Carolina to a group of Georgia Tech graduates in 2008, and I made a prediction. It was actually quoted in a magazine article that we would not have a real recovery until 2011 or 2012. And at the time when I saw it in print, I said, gosh, that seems like a long time away, but it is exactly right. And that market, the real estate market, which is really where the assets of these small banks are in many cases, is still not going to recover for some time. In some cases, we have lot inventories based on current sales rates. These are lots that are already developed and ready to put a house on of 10 years or more. Now, that's not in all communities. In Buckhead, here in Atlanta, there are not nearly that many lots available, but if you go out 20 miles in any direction, you'll find what's called a PVC farm, which is simply a neighborhood that started to be developed. They got all of the utilities in and they were going to put the houses in, but they never got that funding. And that was an example of how when these large financial institutions or financing sources said stop, it just stopped. And those assets that are sitting there, if banks are holding those assets, it is going to take them much, much longer to come out. I'll cover very, very briefly the reason that so many banks have failed. If a bank is required to hold no more, they're required to hold capital equal to a minimum of 10% of their loans. So in a very, very simple example, a $100 million bank, which is a very small bank, has a very small bank has $100 million of assets. $100 million of, yes, that's right, in loans, and then based on that, they'll have about $10 million in capital. Well, if 50% of their loans ended up going bad and they had net recoveries of only, say, $20 million, they've wiped out all of their capital in that process, and that's why that bank has failed.